Indian macros have gotten reset, and how? On Thursday, the rupee rose almost 1%, and at 70 rupees 67 pies to a dollar, it trades at the highest level since end August, actually, August 29. The 10-year bond yield ended at 7.71, and that's the lowest level since the first week of May. And all this because crude has fallen below the $63 mark to its lowest level since February 2018. Crude is a full 30% below its October highs. How does all this change the landscape of interest rates and liquidity in India? Well, the liquidity in the interbank market has also fallen rather sharply in this entire year, and more so in recent weeks, because of a big cash withdrawal in the 2 weeks leading to Diwali, about 50,000 crores, as also big dollar sales by the Reserve Bank this year when the rupee was depreciating fast. So the questions we are asking today is there a scope to cut interest rates and not hike them as the policy stance indicates? Secondly, if stance cannot be changed, is there a scope to cut the cash reserve ratio or the CRR? The CRR is a percentage of the deposits that banks must keep as cash in their with the Reserve Bank. It has to lie idle. Now, can you reduce the amount of that idle CRR cash? That's the question we're asking. We're joined by perhaps some of the best scholars and experts in that field. B. Prasanna, the head Global Markets Group at ICICI Bank, is with us. So is Sajjid Chinoy, Chief India Economist at JPMorgan, and Soumya Kanti Ghosh, the Group Chief Economic Advisor at State Bank of India. Gentlemen, thank you very much for joining me. Well, Prasanna, actually, let me start with you. We've almost forgotten that we have an instrument called CRR. Now that there are other ways in which the, prudential norms are implemented, like the liquidity ratio. Liquidity coverage ratio did not exist for decades now. It's about 1 or 2 years old. Do you think we should not keep so much cash as CRR, and it's time to bring the ratio down?
So, Latha, CRR is not exactly a forgotten instrument. So, okay. If you remember, it has been discussed a lot over the last couple of policies. And the Reserve Bank has actually gone out in a limb to say that that is an instrument which is a long-term instrument, and they would like to keep it at the rate of 4% for a considerable period of time. They have not really wanted to touch CRR as a liquidity infusing tool. So to answer your question as to what are the various tools which can be used for liquidity infusion, so obviously, the open market purchases is one such very important tool which has been used already by RBI. And for the month of October and November, you've seen calendars coming out, and they're doing a good job in terms of infusing liquidity. And the only other way in which you can infuse liquidity is really in the forex market when dollars comes in and RBI intervenes on the buying side and just let the liquidity remain in the system rather than postpone it by doing a forward purchase. So these are broadly only the two instruments. Yes, technically or theoretically, yes, the CRR is also a potential tool which is available, but that's for the Reserve Bank to take a call as to whether they want to really use it as an instrument to change liquidity, because in the past they have always linked CRR along with the rest of the instruments like repo rates as a signaling tool. And so if RBI were still in a tightening stance, like you rightly put it, it is going to be a little tricky for them to look at changing that stance so quickly and say that okay, I'll touch CRR. But of course, having said that, there must be a lot of other considerations also in terms of what is the right level of CRR that potentially a banking system like India can have, and it probably requires far more analysis and a detailed study before we can really comment on that.
Okay, no, I agree, and I think Sajjid should have done that because he was part of the Ujit Patel committee. But before I come to him for that construct, Prasanna, I also wanted to ask you, what is your estimate of the amount of liquidity the system will need? Even now, when we are all complaining, and ministers are complaining louder than anyone else, that there is a tightness in the market, this despite 40,000 crores of open market purchases of bonds being done by the Reserve Bank and notes being put in, 80,000 crores in 2 months. if the Reserve Bank were to only use OMO, then it becomes very distorted, you know. The government sells 8,000 crore of bonds or 10,000 crore of bonds 1 week, and 2 days later it comes and buys back that much. This is almost monetization of deficit. It will distort the yield curve, won't it? So do you think OMO as a single instrument is enough?
So you're right, Latha. It's very difficult to disagree with you on that particular argument. But in terms of requirement of liquidity, what you were asking, I think our estimate goes that till the end of the year, we would expect currency in circulation leakage to be around 1.25 lakh crores further from here till end of the year. And the fact that we are already sitting on a core liquidity deficit of around 1 lakh crore means that the total liquidity requirement, according to our estimate, would be around 2 to 2.25 lakh crores by the end of the year. That is provided RBI wants to really go to a system, a stance of zero neutral liquidity, which is what they have been telling over the last few policies. So it is a call that the Reserve Bank will need to take, whether they are going to wanting to go to zero neutral liquidity, and a call which they need to take as to how much of bonds they can actually use to purchase. Your point is right, that if the government is borrowing 6 lakh crores in a year and RBI is buying more than 2 lakh crores, beyond a point it becomes really unsustainable. But my argument shows that I think there is, my calculation shows that there is, I think, scope for both. They could do maybe around another 75 lakhs to 1 lakh crore of, 75,000 to 1 lakh crore of bonds further, as well as there is some scope for CRR. But that, like I said, that's a call which the Reserve Bank will have to take. That's not for something that, really we can comment on it at this stage. At
this present juncture, of course, we are in the happy situation where the Reserve Bank can actually buy dollars. I mean, we never thought that we will be in this situation. Yeah. Not 6 weeks back did we think that we would be in this kind of a happy situation. But yes, that option also exists. But Prasanna, do stay with me, because I want to ask you about whether liquidity can be increased sectorally. That seems to be the cry from at least political circles, and definitely some sectors of the political economy as well. But Sajjid, first of all, is the calculation of inflation likely to change? Any question of CRR cut or rate stance change will happen only if inflation is durably lower. It seems to be that way, with food disinflation being higher than we thought, and fuel prices suddenly coming like a shock.
You're exactly right, Latha. I think the world and India is a very different place macroeconomically from even 6 weeks ago. I mean, remember what the environment was at the last policy meeting. Oil prices had moved up 10%. The concern was minimum support prices would push up food prices, and there was still a belief that global growth was powering on all engines. The inflation trajectory, in our view, is changing, and changing very rapidly. Right now, assuming that oil stabilizes around 65, you've seen a dramatic food disinflation. And here, I think all credit to the government. I think the fact that food inflation has been moderating for 5 successive years tells me there's clearly a structural component to the disinflation. Supply bottlenecks have been alleviated. The transmission of price signals from consumer to farmer is faster and more complete, and therefore the supply response is greater. So to the extent that food inflation is so exceptionally benign, and assuming that oil is at 65 or between 65 and 70, and assuming that the rupee is stable, we're actually looking at a big undershoot to what the RBI's forecast is. Our own sense is, November inflation, for example, is going to be below 3% at 2.7. But basically, between October and March, our forecast is around 3.3 or 3.4. Remember, what the RBI had was 3.9 to 4.5 was their range for the next 6 months. We're looking at inflation in the low 3s. Even if you take, some of these are base effect induced. If you go from January to June, which are the clean inflation prints, even building in some mean reversion of food prices, we're looking at a 4% inflation average. So yes, the world has changed. The inflation trajectory has dramatically changed. And I think that opens up many more degrees of freedom for the central bank.
Oh, no, not freedom, but even embarrassment, I would say. To the Reserve Bank's credit, the world was screaming that there should be a rate hike in the previous policy, and they stood their ground and did not hike and only changed their stance. But Soumya, now look, even the change of stance needs to be changed once again, is it? if Sajjid is right, and I think your figures were even more dovish when I last spoke to you, please give me your inflation forecast for March. And it looks like the real interest rate, the positive real rate is 3% at 300 basis points, or almost that. Surely this calls for at least a change in stance or a rate cut, or do you think that will be too embarrassing at this juncture? That's why I was suggesting CRR.
No, I think first let the concept of a rate cut out of the window, because I think the Reserve Bank, yes, what he was saying in terms of a Reserve Bank has moved on calibrated tightening. But to be fair to the Reserve Bank of India, oil prices, the volatility in the oil prices, actually nobody expected that oil should decline to close to 60 within a span of 1 month, not even the most optimist of the market participants. So from that point of view, I think the change in the stance in the October policy may have, I believe, what's a little late. It should have happened when the June policy or when the first rate hike was done, because with 2 successive rate hikes and with no change in the stance, I think that was the time when the RBI could have moved at the change in the policy stance. So what I'm trying to say is now a change in the policy stance at this point of time with the current disruptions in the food supply management, I think will look a little odd, and that could actually lead to a discontinuity in the policy description. Now, in terms of the inflation numbers which we are talking about, I think our estimates also for the inflation numbers at least till June of 2019 is very dovish, and next 2 to 3 months inflation number could be in the range of 2.6 to 2.7%, and in March inflation number, which was higher than 4.5% at some point of time, is now actually closer to 4%. So till June 2019, I think any possibility of if the current trends in inflation continues, any possibility of rate action looks a little remote. Though and also a change in the policy stance at this time could also look a little bit uncertain, or looks a little bit odd out of the market uncertainty.
Well, then that gives some currency to those who are saying that the interest rates are too tight. Both of you agree that inflation levels are likely to be at worst between 3.5% and 4%, and maybe closer to 3.5%, which case we are looking at 300 basis point real return, which is tight by any standards. Prasanna, I wanted to first make it more sectoral and more newsy as well. There are some sections which are hurt both by a liquidity tightness and by other problems of, probably trust. If there is sufficient liquidity, then maybe a little part of the trust problem also goes away. I mean the NBFC sector and the real estate sector. Anything at all the policymakers can do to make life easier for them, since clearly there is scope. I mean, the inflation worries are at least not there at all.
So, Latha, I think for that particular problem, my perspective would be for people to really decide and sense whether is it a liquidity deficit, is it a solvency issue, or is it a liquidity issue. And I think all of us know and agree that it's more of a solvency and an ALM gap kind of an issue that has actually led to some of the problems that you're really talking about. Yes, liquidity at the system level has also been an issue, but that's been an issue because of the FPI outflows that we have seen, plus the CIC leakage. That part of the liquidity, the quantity of liquidity, which was a concern, has been addressed by RBI, or as being addressed by RBI by virtue of the open market operations. Now, as far as the targeted liquidity is concerned, yes, you're right that when you try to solve a particular segment's problem by infusing liquidity in general, then it leads to other kinds of asset allocation decisions which would not necessarily be optimal. So it's very important for a regulator to think from an overall macro perspective, does the system require liquidity, and if so, how much liquidity it is needed. So at this point of time, I think the understanding is that overall system liquidity itself is required because we are at a negative, huge negative, and that is the reason RBI is doing OMO. They're not really for the purpose of the NBFC issue that came in. And as far as the sectoral liquidity issues are concerned, maybe some of the demand from the industry perspective has been that they want some kind of a backstop from RBI in terms of lending to these kind of institutions. But there, I think I'm a little bit more conservative in my approach. I would say that the RBI should not get into the business of actually taking credit risk, and it should actually provide the appropriate level of liquidity to the banking system, and then ensure that the banking system is capable of taking the relevant risk appetite and the relevant exposure onto its books and on-lend it to the NBFCs, either by way of direct lending or by way of picking up NBFC portfolios onto its books. I think that's the best way that we should go about thinking about this whole problem.
You have yourself said that system liquidity is 1 trillion rupees at this point in time, and going forward it is going to be 2 trillion in a jiffy, in a few months, a couple of months. So what else can they do? And in the first place, Prasanna, first a shorter question. Is the worst of the crisis over? Because most of the CPs have been rolled over.
I would say a substantial part of the rollovers have happened, and I think the liquidity has started flowing in, and banks have started looking at taking exposures to a lot of these NBFCs, like I said, in various forms, not just direct lending, but also through other methods of buyouts and PTCs and securitization and so on and so forth. And the mutual funds have also not been faced with the kind of redemptions that they were fearing. It's been far lesser. So to that extent, they are also having the liquidity, but it is a question of credit risk and risk appetite right now, because I think the exposure, the lending by mutual funds in the CBLO market is at all-time high. So that clearly means the liquidity is available, and it's up to them to really take the risk of lending to a few NBFCs, which they think is probably over-leveraged.
So real answers for those, headlines are screaming that NBFC companies and real estate need liquidity. There is nothing the Reserve Bank can do. You wouldn't advise a TARP or anything like that.
No, like I said, I'm a conservative, I have a conservative thought process in this particular manner, and I won't advocate some kind of a credit risk lying on RBI's balance sheet. But like I said, it is up to the banking system, and as long as the liquidity available with the banking system is there, provide the right kind of capital and the right kind of environment for them to, take extra risk to lend to these kind of institutes. And it has to come at the appropriate pricing which the institutions think is good for them.
I have the same questions and more in terms of using, more liquidity instruments for y'all. I have to take a break. I'm coming back in a jiffy. This conversation is getting interesting. Don't go anywhere.